All right. Hey, Dave, thanks for having me back. It's always good. I enjoy presenting here in this forum. You typically have some serious traders show up and, hey, traders, welcome. Thanks for being here. I'm looking forward to this presentation. And by all means, ask questions as we go. Let's make it interactive. I hope to have you get the most out of it. So I'm Dean Jenkins of followmetrades.com, and I'm going to talk about how I use Ichimoku Cloud with a very simple version of Elliott Wave. I call it East meets West. And when you get two really good trading systems that agree, that's a really, really good thing. So I'm going to walk through how we do that, and be thinking of any trading symbols that you're interested in, because I'm going to walk through, kind of what I do here, how I do it, and then there'll be a time where I'll offer to analyze any charts that you look at. All right. So as Dave mentioned, hey, there's risk in trading, right? We can make profit, but we got to use risk management. And I'm not a financial advisor. I'm a trader just like you. So I'm not giving financial advice. Show you what I do, and it's been working. All right, here's what I'm going to cover today. I'm going to walk through a couple things. I'm going to show you the tools that I use in my trading. I'll give you a quick little snippet, one piece of Dow theory that I use in my trading for trend analysis, trend confirmation. A brief overview of Ichimoku Cloud, and then a quick overview of Elliott Wave theory, and then I'll talk about how I use them together. I'll share a couple of my current favorite trade setups, and then I'll analyze any stock charts that you are interested in as well. So again, happy to take any questions as we go, kind of real time. All right. So here's, three key tools that I use in my analysis and trading: Dow theory, Ichimoku Cloud, Elliott Wave. So let's talk a little bit about Dow theory. So Charles Dow, he's the founder of the Wall Street Journal, and he wrote a series of editorials in the 1890s that explained, his theory about how the market worked. One piece of that was trend analysis, and he said, hey, a bullish trend is identified by a series of higher highs, higher lows, higher highs, higher lows. That sounds super simple, but if you're in a long trade, if you've ever been in a long trade, and you go up and you're in some profit and you go, gee, should I take profit? Should I get out, or am I going to miss out on future profit? Right? This rule can kind of help you. This definition, and go, okay, well, we got a series. It's not going to go straight up, right? Higher highs, higher lows, higher highs. So it can give you some confidence, and then there's some rules about when that trend ends. And then a downtrend is just the opposite. It's a series of lower lows, lower highs, lower lows, lower highs, right? As long as that pattern continues, up or down, you're still in that trend, right? And hey, Sergio's here, man. I'm glad you're here. Sergio is a customer and a student. Glad you could join us. All right, so that's the Dow theory, trend theory. Higher highs, higher lows for an uptrend, lower lows, lower highs for a downtrend. How do you know when the trend began? Well, a bullish trend begins with 3 data points: a high, higher, low, new high. That's strong evidence that an uptrend is beginning. And then when that trend, that trend will continue, and then at some point it will no longer put in highs, and it'll take out the prior low. That's when it's over. So that's when you close the trade, right? And having a rule like this just lowers the anxiety and stress in your trading, right? Because again, even in a winning trade, you can be stressed out. Oh, should I get it? Should I stay in? Should I get out now? Should I take my profit? Right? And most people end up taking profit too soon, closing too soon, leaving money on the table. But if you got a rule like this, it can really help you. A downtrend is 3 data points: low, lower, high, new low. It ends when it does not put in new lows and goes on, takes out the prior lower high. So that's Dow theory. Let's talk about Ichimoku Cloud. So this handsome fellow is Goichi Hisada. It's known also as Ichimoku Kinku, which is Hayo, which is a one look equilibrium chart. This was developed by this gentleman, Goichi Hisada, who was a journalist in Japan in the 1930s, and he worked on it for quite a while. He published his work in a book in 1969. Okay, now we're going to look at Elliott Wave, and what's interesting is Elliott was working on his theory at the same time in the 1930s, so they were kind of in parallel there. And looking here, just trying to keep up with any questions. Walfredo is asking if it covers futures, Forex. Um, this concept can be applied to any instrument that plots an open, high, low, close bar on any time frame. All right, so how many of you believe that moving averages matter? You know, moving averages are the simplest indicator. They're the most common indicator. Maybe just type in a Y or a yes or a no if you don't think so. How many of you think that moving averages matter? Eric says yes. All right. Larry says yes. So far we have 100% agreement there. Brian says yes. All right. Moving averages are the simplest indicator, and they are the most popular, the most watched indicators. Raphael says yes, but it lags. All indicators lag. All indicators are created from prior data, right? So all indicators lag. They all try to predict something in the future, but they all are created from historical data. All right. So Ichimoku Cloud at its core, it's just a different look at moving averages. And so, you know, the display on Ichimoku Cloud, it's got kind of an exotic name, you know, it's a Japanese name, Ichimoku Cloud, and a kind of a complex display from the factory settings. But at its core, it's just a different way of looking at and calculating moving averages, right? A simple moving average, you know, the most common moving average that people look at on a daily stock chart is the 200 and then the 50-day, right? A simple moving average is the average closing price over X number of previous bars. So a lot of people use 2 or 3 simple moving averages and look for crossovers and direction. Okay, so the 200-day moving average is simply the average closing price over the last 200 bars. And it plots a dot, and then the next day another dot, and those dots are connected to make a line. All right. Ichimoku Cloud is the average. So this is a key difference, right? Simple moving average is the average closing price, regardless of the high and the low for the day. Ichimoku Cloud takes an average of the highest high and the lowest low over some look back period, right? And it uses 3 look back periods and then some derivatives to create the Ichimoku Cloud indicator. And I see Christina typed in yes as well. So thank you, Christina. All right. So here's kind of what it looks like. And here's some key elements of Ichimoku Cloud. The first is what's called the Tenkan line, or the fast moving average. All right. I've got it highlighted here. It's bolded in yellow. Right. And it's the highest high and the highest low average for the last X periods. And that's the fastest period, the shortest period, right? It's similar to a fast moving average line. You know, some people will use a 8 and 21 exponential moving average. So this would be, you know, similar to that 8, but it's taking the highest high, highest low versus the closing price to create that average. A little bit different. Then there's the Kaijun, which is the baseline. It's a slower line than the Tenkan, right? Formula is the same. It's just a longer look back period. But what's key here is you look for crossovers between the fast, the Tenkan, and then the Kaijun, the slow line. Crossovers can indicate trend change, right? But they can also have some false calls because, you know, in an uptrend, you're going to get some up crosses, some down crosses. So just those 2 lines, the Tenkan Kaijun crossing, are not enough to call an entry, right? And there's a third and actually 4th element, right? Some derivatives. So Senku span A means going first or preceding. So that is the fast edge of this cloud here, this shaded area. And it can show support and resistance areas, and it's highly accurate. You know, I say until the trend changes, and even after the trend changes, because when you see breakthroughs of the cloud, it's at the thinnest points. When the cloud is really thin, breakthroughs are more probable, and when the cloud is very thick, support is more probable. Right? The formula for that Senku span A is the fast line plus the baseline, those 2 other indicators divided by 2 and then plotted X periods ahead, right? And that's a longer period. And then the final one is Senku span B, which is the slowest, right? And it's the bottom of the cloud here. Um, and again, it's highly accurate until the trend changes. And again, the cloud, when it's thin, the probability of a break through the cloud is higher. When it's thick, it being supported resistance is higher. So it's pretty cool. This is the longest time frame. It's plotted the longest number of periods ahead. All right, and then this shaded area is the cloud, or in Japanese, kumo, right? And again, the thicker the cloud area, the stronger the support in an uptrend or the resistance in a downtrend. And you can see here in this uptrend, right, price comes down to the cloud, but doesn't penetrate it. When price did penetrate the cloud thickness was at its smallest, its narrowest. So that's super helpful information. All right. So this is kind of what this is what my Ichimoku Cloud setup looks like on TradeStation. It does a great job of identifying trends and predicting support and resistance areas. So when we see a breakout above the cloud, right, it is very indicative of a trend change, a new trend heading up. And then when it breaks down through the bottom, trends ending, we got some choppiness here, right? New trend starting. Okay, so it's cool in that respect. Now, if you've seen Ichimoku Cloud before, you may look at this and go, that doesn't look anything like what I am used to seeing for Ichimoku Cloud. And I would agree with that. Let me show you. So here's my chart on TradeStation. This is how I have Ichimoku Cloud presented. Here's the factory, default settings on your platform. This is what it's going to look like. Well, that is pretty busy, isn't it? Right? We got the Tenkan line. We got the Tenkan line here, the yellow one, the Kaijun, the purple one. This is the Chiku, which I don't use at all. And they've got some weird colors here for the shading area. It's even hard to see price action in this. And the thing about Ichimoku Clouds, what you really want is for a couple things to happen for a trend change. You want to see the fast moving line, right? The Tenkan cross the Kaijun, and you want price action to break above the cloud. That is indicative of a trend change. Well, what I learned after using this for a while was anytime we get a break above or below the cloud, there's always a crossover. It is axiomatic every single time without fail. So if that's true, right, I need these to happen, right? But if price breaks above the cloud, I know they happened. So I don't need to see them, and I don't care about this Chiku line. So I just make all that go away, and then I change the color of the cloud to red and green for up and down. So this is what my display ends up looking like for my Ichimoku Cloud. It's just a shaded area, right? And then I've got a 50-day moving average, this light gray line, and a 200-day moving average, and this is a price oscillator on the bottom. And Raphael's asking, do I favor SMA or EMA? So I favor the tools that I talked about, right? I've got the 200-day simple moving average, 50-day simple moving average. I got Ichimoku Cloud. I've got a price oscillator, and then I'm going to use a simple version of Elliott waves. Those are the tools I use, right? So simple moving average here for me. And on a daily stock chart, the 200-day moving average is the most popular indicator on the planet. So if everybody's watching that, I want to watch it too. And it turns out it does quite often provide support and or resistance, and you can see it's also quite often coincident with the Ichimoku Cloud. So I hope that helps, Raphael. All right, let me get back to my slides. Okay, so that's a little bit about Ichimoku Cloud. Here, Elliott wave. So Ralph Nelson Elliott, he was working on this at the same time in the 1930s that Goichi Asada was doing his research on Ichimoku Cloud. So Elliott wave, people have complicated this over the years, and if you heard me say Elliott wave, you may have rolled your eyes and go, yeah, I've looked at that, it's overly complex, not repeatable. I use a very simple, repeatable approach to it. And I think the very core of Mr. Elliott's theory, he talked about collective investor psychology, crowd psychology, moving between optimism, pessimism in natural sequences or waves, impulsive and corrective waves. So here's the basic Elliott wave, 5-wave pattern here. You get a beginning, wave 1 and 2, which are small. Then you get the first impulsive wave, which is 3, a big move, right? After a big move, after every big move, you can go look at every chart, right? After every big impulsive move, there's always a correction. And what's cool is that correction often, there's no guarantees, there's no 100% things in trading, right? But the high probability is that this correction is going to retrace to some key Fibonacci levels, right? It's a predictable level for the retracement. And then after it retraces, right, there's going to be another impulsive wave up to new highs, and then there'll be a complex correction. Those are hard to trade, right? So I'm trying to trade wave 3, a big impulsive move, wave 4, a predictable correction, and then wave 5, a follow-on to that original big impulsive move. Simple, right? So I'm looking for these, I'm analyzing these waves. What are we in? Are we in the first impulsive move? Are we in a correction? Or are we in a follow-through, a continuation of the original trend? And I use Dow theory and Ichimoku cloud to confirm that it's really happening. You just keep it simple, right? Use a few tools, have a few setups, right? Not every chart is going to display that setup, but when I see something that I recognize and that I know is high probability, that's where I want to trade. This is part of a classic approach to Elliott wave that people have built on top of Mr. Elliott's work. And you got this grand super cycle and a super cycle and intermediates, and I don't even know what all this stuff means, right? You multiply these together, there's 144 pattern permutations. I can't memorize that. I can't even recognize that. And you get these, you see these Elliott wave charts that are all marked up with this stuff. It's like, I can't make any sense of that, right? I'm looking for this. Big move, correction, a follow through. That's all I care about. And that can happen in a bullish move or in a bearish move. You flip this upside down, it's exactly the same going down. All right. So this is nonsense, in my opinion. And I learned this from Bennett McDowell, founder of traderscoach.com, and he is the Elliott wave technique simplified guru. And I was mentored by him about 10 years ago, learned this stuff. And as he was writing this book, he invited me to help him. So I'm a co-author on this book. And it's a good one. It's on Amazon.com. So if you want to learn more about a simple approach, a repeatable and effective approach to Elliott wave, go to Amazon. That book belongs on every trader's bookshelf, in my opinion. I don't get any commission or anything for that, so I just think it's a great resource. All right, how do we bring this all together, right? So here's how Elliott wave looks on a chart, right? Wave 1 and 2, because nothing's as clear as you draw it on PowerPoint, right? A little move, right? It's down, it's channeling. We got, oh look, we got a high, we got a higher low, new high. Wave 1, wave 2, big impulsive move, got a correction. You can see these are Fibonacci retracement lines, these blue lines, 38.2 to 61.8. That is the sweet spot of a retracement, a wave 4 retracement. 70% of wave 4s are going to retrace into this zone. Afterwards, we look for wave 5, and we look for, the trend to change, high, higher low, new high. And we can then set a wave 5 target zone using Fibonacci extensions. These are Fibonacci retracements. These are extensions. After these 3 data points, and you draw it from wave 2 to 3 to 4, where's wave 5 going? Pretty cool stuff, right? This was an actual trade we took on Vail, right? And we can see we got a wave 3 entry because after, a downtrend and then channeling, we had, 1, 2, 3, right? We had a high, higher low, new high. We had price breaking above the Ichimoku cloud. That's a great entry, okay? And it took it all the way up to here, right? And this was from $3.50 up to $6, right? That is, like an 80% win, right? And then it ends, right? Like I said in Dow theory, all impulsive moves in, all impulsive moves in, and you can tell it ends when you get a lower high, new low, right? So wave 4, there probably wasn't enough profit, because you got to have a good reward or risk on a trade to take it, right? And there wasn't enough profit potential for this thing to go down. By the time it proved itself, low, lower, high, new low, it didn't prove itself until here. It's already near the retracement zone. So you just wait it out because we know high probability there's another impulsive move coming, and here it comes. High, higher, low, new high, right? Up to the target zone, and this is what it looks like playing out, right? There it is, high, higher, low, new high, high, higher, low, new high. Those are your entries, right? Pretty good trade. And that was a real one that I took myself and published to my subscribers. All right. We also use Dow theory to manage a trade, right? So once we get in, we're going to put our stop at that prior low, right? We got a high, higher, low, new high. I'm going to put my stop at that initial low, and then as it plays out, I'm going to trail my stop to here, to here, to here. And I know some people are very, very leery of, placing an actual stop order. They worry about market makers chasing their stops and, giggling like gremlins and running around and stopping them out and all. I don't buy into that, and it's okay, because when I say there's a stop, that means a point you're going to exit the trade. You don't have to have a literal order there. You can place an alert, right, with your trading platform, with your broker, and if price goes down to that level, then you want to get out. And if we look back, right, we had a high, higher, low, new high. So I'm going to put my stop at this low. Well, why is that? Well, if you think about Dow theory, the definition of a trend, if price were to go down below this level, that would mean, oh, that trend failed, right? So that's where I put my stop, is at the point where the trend will have failed. And then I will calculate my position size based on the distance from my entry to my stop. Hope that makes sense, okay? And we trail it as new lows are put in, new highs are established. We move the stop, we move the stop, we move the stop. Eventually it gets hit, we close the trade, right? Let the trend run as far as it'll run. Keep the winners big, losers small, all right? Let me analyze a couple of your symbols, and then I will share my top trade ideas. I see somebody typed in Disney earlier. So I'm gonna look at Disney, and then while I'm looking for that, type in a few more if you'd like me to look at, okay? Oh, we got a couple coming in here. Hey, Tom, Brian, we'll get to those, okay? But let me get back. Thiago wanted to look at Disney. Look at Disney. All right. This is super clear. This is super easy, okay? Because I should have fired up my my pen. Let me do that now. Whenever I look at a chart like this, I want to draw on it. I want to make some points here. There we go. It's my favorite tool. It's called Ink to Go. If you do any presenting, you need ink to go. All right, look here. Wave one, wave two, wave three. Big impulsive move. I think you would call this move from $90 to $200 a pretty big move, right? I'm going to call this wave one, this wave two, this wave three. Oh, what did we have here? Low, lower, high, low, lower, high, low. That looks to me like a correction. And look, my momentum oscillator went negative. And now what do I have? Well, kind of a little channel, but then, oh, this is a low, lower, high, new low, or high, higher, low, new high. And currently price is above the Ichimoku cloud. This looks for the world like could be a wave five beginning, doesn't it? So let's just quickly look. Fibonacci retracement, okay? There's wave 2 to 3. The retracement, it fell a little short of here, but that's okay. I said 70% will land in this zone, 15% will fall short, 15% will go more. But it was a clear correction, right? With lower lows, lower highs, lower lows, lower highs, and negative momentum. So that was a good wave 4. Where is wave 5 going to go? Well, I use my Fibonacci extensions. I go from wave 2 to 3 to the bottom 4. And the wave 5 extension, the target zone for Disney, is between these two green lines, a 61.8 to 100% Fibonacci extension. So the bottom of that is 234. Now, is that going to happen tomorrow? Probably not, right? Probably not. If you look at the kind of the logarithmic impulsive region of wave 5 here, right? It took from October 30th to March 9th. That's 5 months. Okay, we should expect something similar, but there will be legs that you can trade in shorter time frames, right? But if we're going to get a move like this, we should expect this to take, kind of a similar time frame to this. So when I say, hey, the target's 234, and come Friday, it's not at 234, don't go, hey, Dean, you were totally wrong, right? That's going to take weeks or months. But there can be short-term moves if you like shorter-term swing trading, and that makes a higher high, higher low, higher high, right? You can trade those, okay? All right, we got a few more. Oh, Christina says she loves the enthusiasm. Yeah, I do like this. This is cool stuff, right? Pfizer for Tom. I'm going to keep an eye on the clock here. I got 14 minutes left by my clock here. And Dave is a highly disciplined clock. He will kick me off, which is good because that means everybody else gets to start on time. All right, Pfizer for Tom. All right. So Pfizer, the first thing you want to do, I like to start on a daily stock chart looking at about 18 months worth of data, right? I look here. It was just a choppy kind of mess up until this point. Okay, everything to the left of this, I'm going to pretty much disregard, right? Now we got a big impulsive move. We got a high, higher, low, new high. So we got a wave 3. Okay, it's currently correcting. High, higher, low. Okay, it's currently correcting, pretty big move down, and the target is here. And look at the middle of the correction zone is at about the 50-day moving average. So I would think that's about where it's going to go. So I would not go long on Pfizer just this moment, right? Because we got right low, lower high, low, lower high. It's in a downtrend. It's in a correction, right? No question, right? Looks like it's going to go probably about to here-ish, right? And the problem here is if you were to go short, you would probably set your stop here at this gap. You would take your entry to current price, right? And your target is going to be here. So it's a little bit bigger. It's not much. The reward to risk on this isn't great. So I would wait on Pfizer for me. Let it finish the correction. Let it make, get down into this region, then make high, higher, low, new high. A few weeks, month or two, then there's another impulsive move up coming, probably, right? Nothing's guaranteed. Brian wants to look at Tesla. We can't do a webinar without looking at Tesla, can we? A pretty similar pattern, isn't it? Right? Big wave 3 up, perfect correction, and now it's in wave 5. High, higher, low, high, higher, low, high, higher, low, new high. Where's Tesla going? Now, one of the things you have to watch is it can always stall at prior reversals, right? So the target's up here at 1,040, but this is a very sharp reversal. It could fail here, and it could fail here. And so if I were to get in this now, my stop would have to be under this low. All right, so its target's here. That's not very good, right? Its target's here. It's about 1-to-1. I want trades that have a high reward to risk ratio, meaning if I'm right, I'll win more than I will lose if I am wrong. So it looks like Tesla's in an uptrend, and if you're patient, it could work its way up. If you're doing a little bit shorter term, it could fail here at about 778. And there's another potential reversal at resistance up here at, 890. Myrna, of course, the berry. All right. So a pretty short reversal, but I think it made it, right? This is clearly an impulsive move, right? That's what you want to look for, is a big move like that. Clearly. Where did it start? We're going to call this one too. Pretty good reversal. And where's it going? up to 596. Here's the prior high, potential failure. So on this one, you're going to put your stop here. You're going to take your entry if it opens tomorrow, somewhere around this price, right? And an intermediate conservative target is going to be here. So you could actually, this distance from the entry to the stop is more than the distance from the entry to the target. So it's not good yet, okay? Yeah, if it gets through this high, then you go to evaluate, where would the logical stop be and how's the reward to risk look, right? AMD and plug for Mitch. Okay, I'll do this. I'll do as many as I can. I want to show you a couple of my favorites, and then let you know how you can find out more. AMD. I used to work for Intel Corporation, so AMD was the enemy. AMD's the stock chart looks way better than Intel's right now. This actually looks pretty good. Here was wave 3, here was 4, it's in 5. Little pullback here, right? Had a big big move. Little pullback. Looks like it's finding. Look how the Ichimoku cloud is absolutely showing you the support area, right? Comes to the cloud, finds support. It's not going down through it yet. I would wait. Let's see it get underway. Here's this little high, right? Let it take out this high. If it does take out this high, you can put a stop under this because that's going to be a low. And now you got a nice target, right? Up in this zone somewhere, right? You can put a target in the middle of the zone. Look at the reward to risk. If this happens, right? This is conditional. If AMD goes above 114.91, right, then your stop would be here. Your target's going to be, that's 5 to 1, man. 4 or 5 to 1. That could be good. So keep an eye on that one. All right, Plug. I like Plug. It's an interesting company. Hydrogen power cells, and they are volatile. Okay. Now here's something interesting. Here was obviously a big impulsive move, and then it cratered. This red line, if you can see it, right? Fibonacci retracements are good unless they go too deep. When they go below this red line, it's too deep. So this becomes the new impulsive move. So this is actually a bearish. So this is the impulsive move down. This is the correction. And according to technical analysis, this would be heading lower, which is too bad because I think Plug has cool technology, but we trade the realities on the chart, right? And you can see the Ichimoku cloud has shifted to red, prices below it, and the edge of the cloud is providing resistance. So the target for Plug, if it gets going, is actually to the downside. And you don't, obviously it's not going negative, so you would set a target at these prior lows, right? It's kind of, that would be where your target is, right? And so you'd look for, we got low, lower, high. I'd let it turn and start going low, and then there could be a potential short on Plug. All right, I'm going to take 2 more, and then I'll show you mine. All right, NET. And I already looked at Pfizer. Did you catch that, Greg? We looked at Pfizer earlier. All right, NET. You missed it. Wave 3, wave 4, wave 5. I'll bet you. I don't think I've ever looked at this one before. I certainly don't have any markup here. I'll bet you this is in the target zone. All right, so let's see. Trend started here. There was the first impulsive move. Here's the perfect correction. Amazing. Right into the wave 5 target zone. So for me, it's too late, right? The entry on this trade would have been here. That would have been a good entry. Would have failed. And then here would have been a better one, right? You'd have made a nice trade. 77 up to 131, nearly doubled, right? As it broke the cloud here the second time, that was an awesome entry. Christina says, what about trading options on PFE? So any stock chart that has a good directional setup, I trade with options, right? So let me show you my current favorite setup. Just took it this morning. It's target short. Okay. So Target had this huge wave 3 run up, big impulsive move. It's starting to correct clearly, right? No question. Low, lower high, new low, negative momentum. It's down below the cloud. It's down below the 50. We took a short. So this red line is my current stop at this prior high, right? This blue line is where I took it short at the market open today. This green line is my target, right? It's at the top of the Fibonacci retracement zone. Look at the reward to risk, right? If this distance versus this is 3 or 4 times more, right? And so I got a great directional trade set up on target. I think it's going down. I think it's going down to about 203, right? My choice to trade that, and I'll just give you this, was to take the October 15 240 strike put, right? And I paid 435 for it. It's all their profit already, right? Why not? Well, I put all the cash out there to short this position. I just went long the put. Okay, I hope that helps, Christina. All right, I got 4 minutes left. Hey, if you liked what you saw here and you wanna you wanna see more, you wanna work with me, I got a special offer for you, right? So I published these trades. I showed you Target, right? Is a short we just took today. Oh, let me show you another one. I gotta show you another one. It's a really good one. I might take it tomorrow. Long Iridium, right? Iridium is a great long setup. Target up above 55. Woohoo! Here we go. It's super clear, right? Big impulsive move, perfect correction, continuation into 085. All right. If you would like to follow along with the trades that I take and publish to my subscribers, you can try it for 30 days for 37 bucks. There is the URL. Dave, I think, is going to post that in the chat box for you. Hopefully, there it is. I see it. Awesome. Okay. 100% money back guarantee. 30 bucks for 37 days. $37 for 30 days. After that, it's 97 bucks a month, right? That's 25% discount off the list price. That's 100% money back guarantee. Come check it out. If it's a good fit, stay. Most people do. If not, it just didn't work. You send me a note. I will give you 100% refund. No questions asked. No hard feelings, right? Only want, only, it has to work for you, and that, otherwise that's okay. Right? So no questions asked. And hey, but wait, there's more. Oh, wait, here's what you get, right? You get a watch list of potential trades I've found. You get alerts via email, and I've got a dedicated app that sends alerts when I'm getting in a new trade. You get the exact details of the trade, the entry stop target. Most of them can be traded with either the shares or the options, your choice. So I send that out to you in the alert. When we make a change, we move a stop, take profit, close the trade, I send an alert as well through the email and the dedicated app that you're welcome to download on your phone. Get a nice pop-up alert. You have a live trading room Monday through Thursday, 30 minutes at the market open. You can attend if you like. It's not required. We record it. There's a recap, right? You're going to get the alerts either way, but a lot of people like to attend, kind of see it real time. You get a weekly live chat session Wednesday evenings if you can't make the morning session. You get a one-on-one consultation with me, and I provide some tools for risk management and some option trading tools and training to use my alerts and to do them with options if you choose, ongoing support and training. And wait, there's more. I have a course. The list price is $247. It's my Ichimoku Cloud East meets West course. It's my proprietary indicator settings. I have a proprietary indicator that you can load on TOS because their factory one won't do my settings. The one on TradeStation will. Most other platforms will. But you get my settings, a written study guide, training videos, and a printable trade setup cheat sheet. That is included. If you take the $37 trial for 30 days today, you'll get the stock and option picks, you get the trading room, and you will get the course. And that is the link, and Dave has posted it in the chat area. All right, and it looks like I have managed my time well. I'm right up against the end. I really appreciate you guys attending. Appreciate the stocks that you wanted me to look at. I hope you found that helpful, and I would love to have you join the service. 37 bucks, pretty low risk with a money back guarantee. Come check it out. Love to see you in the trading room tomorrow morning at the open, and let's see if we can knock out some good trades.